Hello, my name is Phillip Alphonse and welcome to this Adjusting Entries screencast. Now if you think you may fail the Adjusting Entries component of your exam, then listen up because it's time for you to learn. Adjusting journal entries record unrecognized revenues and expenses in the period in which they were incurred. They are necessary because sometimes the exchange of cash doesn't always coincide with the earning of a revenue or incurrence of an expense. Thus, adjustments are needed to be made at the end of the period. As all boring people know, there are two bases of accounting. However, adjusting journal entries are recorded under the accrual basis. It will be accrual exam if you forget this. You must always remember the accounting equation. This is like the 11th commandment for accountants. Assets equals liabilities plus owner's equity. Debits, which are always written on the left side, must equal credits on the right. Expenses, assets, and dividends are recorded in the debits column, and revenue, equity, and liabilities are recorded in the credits column. This is extremely important to remember for your exam. Adjusting journal entries are necessary in 4 scenarios: when recording deferred revenue, accrued revenue, deferred expenses, and accrued expenses. Now relax, before this gets overwhelming, let's break it down even further. Deferred revenue is when cash is received before the revenue is earned, whilst accrued revenue is when cash is received after the revenue is earned. Deferred expense is where cash is paid before an expense is incurred, whilst accrued expense is when cash is paid after an expense is incurred. It's important to never refer to cash in an adjusting journal entry, as cash transactions are recorded at the time when the transaction occurs, whilst adjusting entries are recorded at the end of a time period. Now let's finish this off with some simple examples. If Jack the painter receives money from a client for painting a house which he has yet to paint, he must debit unearned revenue as it is a liability and credit service revenue as his revenue is rising. This is a deferred revenue. However, if he receives the money after his service was provided, accounts receivable will be debited as it is an expense, and service revenue will be credited as revenue is a credit. This is accrued revenue. If a company receives a bill in August for the utilities they used in July, they must debit the utilities expense and credit utilities payable to recognize the expense. This is an accrued expense. Finally, if Jill paid for next month's rent on July 31st, she would debit $1,500 for rent expense and credit $1,500 to prepaid rent, as this is rent she has not yet used. This is a deferred expense. And that's Adjusting Entries 101. Happy accounting!